VentureCast?
It's no secret that the stock market has been on a roller coaster ride in recent years. With huge gains followed by steep drops, it's natural to wonder if the market is about to collapse. So, is the stock market about to crash? Expert 1: There are always concerns about the stability of the stock market. However, it's important to remember that the stock market has a long history of ups and downs. Expert 2: That's right. While it's impossible to predict exactly what will happen in the future, it's important to keep a long-term perspective when investing in the stock market. Narrator: So, what are some of the factors that could potentially lead to a market crash? Expert 1: There are several factors that can contribute to market instability. Economic downturns, political instability, and global conflicts can all impact investor confidence and lead to a drop in stock prices. Expert 2: Additionally, we can't forget about the role that speculation and investor psychology play in the market. When there is a lot of fear or excitement about a particular stock or sector, it can lead to exaggerated price movements. Narrator: So, what can investors do to protect themselves in the event of a market crash? Expert 1: It's important to diversify your portfolio, and not put all of your eggs in one basket. By spreading your investments across different sectors and asset classes, you can mitigate the risk of a single investment tanking your entire portfolio. Expert 2: It's also a good idea to have a long-term investment plan in place. Don't get caught up in the hype of short-term market movements. Stick to your plan and ride out any bumps in the road. Narrator: Is there any way to know if a market crash is imminent? Expert 1: Unfortunately, there is no surefire way to predict when a market crash will occur. However, there are some warning signs to look out for. For example, if the market is experiencing a prolonged period of rapid growth, or if there is a bubble in a particular sector, it could be a red flag. Expert 2: It's also important to keep an eye on economic indicators such as unemployment rates, GDP growth, and inflation. If these indicators start to show signs of weakness, it could be a sign that the market is at risk of a downturn. Narrator: So, is the stock market about to collapse? Expert 1: It's impossible to say for sure. However, it's important to remember that the stock market has a long history of ups and downs, and it's always a good idea to have a diversified portfolio and a long-term investment plan in place. Expert 2: It's also crucial to stay informed and pay attention to economic and political developments that could impact the market. By keeping a watchful eye and staying disciplined, investors can weather any storm that may come their way. The stock market has experienced several collapses throughout American history, resulting in significant economic turmoil and financial loss for investors. Some of the most well-known stock market collapses include the Panic of 1907. This collapse was triggered by a failed attempt to corner the market in copper, leading to a series of bank failures and a severe recession. The Wall Street crash of 1929, often referred to as the Great Crash, this collapse is considered the most infamous stock market collapse in history. It was caused by speculation, overproduction, and a lack of regulation, leading to a massive drop in stock prices and a prolonged economic depression. The Black Monday crash of 1987, on October 19, 1987, the Dow Jones Industrial Average, experienced a 22.6% drop in one day, the largest single-day decline in history. The crash was caused by a combination of program trading, portfolio insurance, and economic uncertainty. The dot-com bubble. During the late 1990s, the stock market experienced a significant bubble in internet-based companies, leading to a sharp increase in stock prices. When the bubble burst in 2000, it resulted in a significant drop in stock prices and a recession. The Great Recession. the stock market experienced a significant collapse in 2008 during the global financial crisis, known as the Great Recession. It was caused by the housing market crash, the collapse of Lehman Brothers, and a lack of regulation in the financial industry. In addition to these major collapses, the stock market has also experienced numerous smaller declines and corrections over the years. Despite these setbacks, the stock market has generally trended upwards over the long term, providing investors with the opportunity to grow their wealth over time. However, it is important for investors to understand the inherent risks involved in the stock market, and to diversify their portfolio to minimize potential losses. As the stock market continues to fluctuate, it's important to consider the possibility of another collapse. While no one can predict the future, there are steps you can take to prepare for a potential market downturn. First and foremost, it's essential to have an emergency fund set aside. This is money that you can use in case of unexpected expenses, such as a job loss or major repair. Ideally, your emergency fund should be enough to cover your living expenses for at least 6 months. Another important step is to diversify your investments. Don't put all your eggs in one basket by investing heavily in a single company or sector. Instead, consider spreading your investments across different asset classes, such as stocks, bonds, and cash. This will help to mitigate the risk of losing all of your money if one particular investment doesn't perform well. It's also a good idea to review your investment portfolio regularly to make sure it's aligned with your long-term goals. If you're approaching retirement, for example, you may want to shift more of your investments into less risky assets, such as bonds. On the other hand, if you have a longer time horizon, you may be able to afford to take on more risk in pursuit of higher returns. In addition to reviewing your investments, it's important to stay informed about the overall state of the market. Keep an eye on economic indicators, such as employment and inflation rates, and pay attention to any news or events that could potentially impact the market. This will allow you to make informed decisions about your investments and to take action if necessary. One potential action you could take is to sell off some of your investments if you see warning signs of a potential market downturn. While it's never fun to sell investments at a loss, it's better to cut your losses and move on than to hold on to an investment that could potentially plummet in value. Finally, consider working with a financial advisor or professional to help you navigate the market. A financial advisor can provide valuable guidance and help you create a long-term financial plan that takes into account your goals and risk tolerance.